Kalshi is doubling down on commodities as a new wave of traders seeks direct access to price movement and risk. In a moment when inflation fears still ripple through portfolios, Kalshi announces market expansion and a dedicated hub designed to serve institutional and retail users alike. The move signals a broader push to turn binary event contracts into mainstream tools for hedging, pricing, and speculation. By expanding commodities coverage, Kalshi aims to capture demand from energy, metals, and agricultural markets that often react most sharply to supply shocks. This topic matters now because real assets connect diverse markets and everyday costs. Kalshi is a regulated exchange that lets people bet on whether prices rise or fall for various assets. The company is broadening its commodity contracts to cover more markets, products, and delivery windows, and it is opening a dedicated hub to streamline listings, risk controls, and user experience. In plain terms, investors can create or trade contracts tied to real-world price moves rather than owning the asset itself. The expansion means more liquidity, faster pricing, and clearer hedges for businesses confronting volatile inputs such as crude oil, copper, soybeans, and natural gas. Beyond hedging, traders seek directional bets on weather and policy shifts. Historically, Kalshi emerged from the growth of event-based betting and regulatory clarity around financial derivatives. This is part of a longer arc that began with traditional futures markets and later embraced binary-style contracts. Regulators cautiously allowed such products as tools for risk management rather than pure speculation. Over the last decade, commodity trading has shifted toward electronic venues, with major exchanges expanding access and speed. Kalshi now leans into that trajectory by framing commodities as tradable events tied to price moves, seasonality, and macro shocks that traders have tracked for generations. This history frames today as a natural next step in access and efficiency. Reaction across markets has been mixed but increasingly constructive. Traders price in a broader pipeline of listings, clearer settlement rules, and potential liquidity depth as more players join the hub. In practice, this can mean tighter bid-ask spreads for commodity options and faster volatility measures during sudden shocks. The shift comes amid ongoing conversations about energy pricing, supply chain resilience, and inflation trends that keep risk premiums elevated. Early chatter around the hub suggests more collaboration between institutions and retail platforms, potentially lifting participation and widening the everyday relevance of commodity-based bets. Investors are watching liquidity, speed, and the regulatory guardrails. Several groups stand to gain or adjust strategies. Commodity producers and consumers may benefit from clearer hedging tools and price insights tied to real-world events. Banks and brokers could see more client activity, new risk management products, and revenue upside from expanded trading. Asset managers, pension funds, and high-net-worth individuals will evaluate how a dedicated hub reshapes allocations to energy, metals, and agriculture. Retail traders could access cheaper, regulated exposure to spot price moves. In short, the expansion touches miners, refiners, farmers, airlines, and anyone betting on price volatility. The ripple effects could affect supply chains, credit markets, and downstream pricing decisions across industries. Macro forces frame Kalshi's expansion as part of a wider shift toward financializing real assets. Inflation dynamics, central bank policy, and currency volatility shape hedging demand and risk appetite. Energy markets remain sensitive to geopolitics, sanctions, and weather extremes, while supply chains react to policy moves and trade tensions. A dedicated hub could attract capital looking for compliant exposure rather than off-exchange bets. The backdrop includes fiscal stimulus, budget deficits, and evolving energy transition narratives that push investors toward commodities as ballast against fiat currency devaluation and unpredictable rate paths. Geopolitical shocks in major producers and refining hubs can rapidly amplify price volatility and opportunity. Smart money is assessing the hub as a potential liquidity magnet and risk management upgrade. Institutions are running scenario analyses, stress tests, and regulator reviews while weighing whether to list or trade new contracts. Some funds may increase allocation to commodity bets, diversifying beyond equity and bonds. Retail platforms are promoting educational content and simplified interfaces to attract newcomers. In practice, this means more price discovery, tighter quotes, and greater transparency during market stress. If enough players participate, the hub could shift the balance of power toward data-driven hedging and informed speculation. Nonetheless, investors worry about concentration risk, regulatory uncertainty, and the potential for erratic liquidity. Any expansion carries risks that could derail momentum. If liquidity fails to materialize, spreads widen, and pricing becomes unreliable during shocks. Regulatory scrutiny could slow listings or impose friction, reducing the hub's appeal. Over-reliance on binary bets may amplify crowd behavior, creating sudden losses when events diverge from expectations. There is also counterparty risk if major players retreat, and technology glitches could trigger cascading liquidations. Finally, commodity markets remain exposed to macro surprises, such as disease, weather anomalies, or geopolitical escalations that disrupt price signals and erode investor confidence. Without robust risk controls and diversified liquidity, the hub could struggle to attract steady volumes. For retail investors, the takeaway is education plus cautious exposure. Start by treating Kalshi-style commodities bets like a small sleeve of a diversified portfolio, not a core position. Use defined risk limits, set stop losses, and monitor hub liquidity. Consider focusing on well-understood markets such as crude oil price movements or wheat price gaps rather than niche contracts. Leverage educational content from reputable sources, practice with paper trading, and watch for regulatory updates that could alter rules. Finally, compare costs across platforms and ensure you understand settlement dates and payout structures before placing trades. Patience and discipline beat impulse betting in volatile markets. Looking ahead, Kalshi-esque Commodities Hub could recalibrate how risk is priced across a wide range of products. If adoption meets expectations, we may see deeper liquidity, tighter spreads, and more precise hedges that translate into steadier corporate budgets and consumer prices. Yet the outcome depends on regulators, counterparties, and how quickly education reaches the broader audience. Investors should remain measured, track contract rollovers, and compare the total cost of ownership across platforms. Markets will watch user adoption metrics, regulatory timelines, and the speed at which new listings appear. If you found this valuable, subscribe to the Commodity Brief for weekly insights on alternative assets and commodities.